makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a Fed rate cut this month appears to have been cemented after Friday's weak jobs data. The question now is, how big of a cut will it be? We'll dive into that with BlackRock's Reid in a moment. Of course, another key focus this morning, political uncertainty in France and Japan. We'll get the latest from our reporters, Caroline Conan and Jill Decis. Let's start in France, where the Premier is likely to lose his job in a conference vote today. France's inability to fix its public finances have, of course, led to three governments in little more than a year. So we're joined by Caroline Conan, who's outside the National Assembly in Paris. Is Caroline, Bayrou's removal a done deal?
It is pretty much a done deal, Francine. 9 months after the collapse of his predecessor, Michel Barnier, Prime Minister Francois Bayrou will likely fall in this vote of confidence tonight. 98% chances, according to Polymarket. And I was talking just half an hour ago with a socialist MP who was telling me there is no backtrack, there is no compromise in sight. We will not support the vote of confidence, meaning that clearly Francois Bayrou will not be able to have a majority tonight. Now, what happens next, of course, is in the hands of President Macron. The socialists do believe that it is their turn to get the next prime minister, which is actually something that President Macron hasn't tried yet. We've had 4 prime ministers. It's going to be the 5th one in less than 2 years, but he hasn't tried going the moderate left-wing route quite yet. So perhaps that is one way to go, even if that means possibly losing some of the moderate right Republicans, because of course any budget proposed by the socialists will mean that the spending will be watered down, and clearly that may not be the most reassuring scenario for the markets, even though Bayrou's fall is mostly priced in. And the only concern from the markets at the moment is if we have new snap legislative elections or Macron's resignation, something that the president has ruled out at the moment.
Caroline, thank you so much. Caroline Conan in Paris. Now, Japanese Prime Minister Shigeru Ishiba has announced that he'll step down, setting in motion a leadership race that threatens to unnerve investors as Japanese markets face more instability. Well, Ishiba says that he will stay on as Prime Minister until his successor takes over. For more, let's get straight to Bloomberg's Jill Decis. Jill, who might succeed Ishiba, and what challenges might be next for the next Prime Minister?
Well, that's right, Francine. I think at this point, this was pretty clearly headed toward an exit for Ishiba. He lost 2 major elections recently, so really kind of is jolting the leadership party within Japan. Now, looking to what's next, we've really kind of zeroed in on 2 candidates. You've got Shigeru Koizumi. He's the son of a former prime minister who's much more of a reformist, and so he's more likely, if he were to succeed Ishiba, to be more of a reformist candidate. But I really think it's Sanae Takaichi. This is a more right-wing candidate. She's really the more interesting possibility here. She's much more of a protege of former Prime Minister Shinzo Abe, so much more likely to be somebody who's a fiscal expansionist, a looser monetary policy. And so if you're looking at the Japanese bond market and potential reasons for that upward pressure there on long-term yields, she's really the candidate, I think, to look out for. She actually came in second to Ishiba when there was a leadership race held last year. So that's also why she's considered a very likely possibility here. But I do think that potential for a return to Abenomics within Japan, particularly if you're looking at somebody that would be Japanese first woman prime minister, I think that's a really, really interesting race to watch here. This is a leadership election that could happen somewhere in early October. So again, going to be a really, really interesting several weeks in Japan.
Jill, thank you so much. Jill Decis there with the very latest on Japan. And we're also joined by Wei Li, a global chief investment strategist at BlackRock. Wei, there's a lot to talk about. So, of course, there's that jobs report on Friday. There's everything in terms of political turmoil or instability that we're seeing in Japan, but also France. But I love your weekly commentary. It basically says, what are the 3 things that I've learned so far? And they're always straight to the point. Where are they?
Well, we have had a very eventful year so far this year, but what we have learned is that if we have a very clear framework to navigate policy uncertainty that really help us cut through the noises a little bit, so understanding the things that can change quickly versus the things that cannot change quickly, and compare that versus what markets are pricing, which oftentimes means that markets are getting carried away, creates tactical opportunities that we want to lean into, which we have leaned into, and this is something that we're taking into the rest of the year.
Wait, when you look at the jobs report on Friday, does it change everything for the Fed going forward?
I think something very subtle and very interesting is happening. So when we have the job report on Friday, surprising to the downside, we're talking about 29K on average the last 3 months or so. And just for context, this is like a tenth of what we had at the beginning of the year. So this is really meaningful slowdown here below our estimate of break even. And I think the really interesting and potentially subtle thing that is happening right now is that this creates enough macro justification for the Fed to go ahead with near-term rate cuts without its independence being brought into question. So in the near term, the administration and the central bank are both kind of seeing near-term rate cuts as perhaps the best course of action, so somewhat in line. And what does this mean for markets? It means that some of the previous independence erosion premium being priced out of the markets could actually get priced back in. It's good for equities, but also good for bonds. You see long end now coming back down, perhaps in part reflecting rate cuts, but also in part reflecting some of those independence discussions that actually being priced out, some of those fears being priced out. But from here on, actually some really big questions still stand, because right now it may feel that the tension between monetary and fiscal is somewhat alleviated because of the weaker job number, but just for how long, right? Because they haven't disappeared, the tension. And also the question is the weaker growth. At which point does it stop? Does it get worse? Does it get much worse? And if it gets much worse, then that would offset the positive boost from Fed cut, and that actually could be bad for risk assets.
So wait, 25 or 50 basis point cut in September?
We think 25, but there is a risk of 50, which is something that markets are pricing in as well. Well, cautiously positive risk, but lots of things are happening at the same time.
Is there a risk that actually inflation goes higher, growth, and the labor market deteriorates, and then you're left with a kind of nightmare scenario for both policymakers?
That's always the very tough trade-off that we have been talking about facing central banks in this environment of supply constraint. We have the inflation number this week. Given how weak payroll has been, maybe some of the pressure on the service side is not going to be as strong through the wage feed through, but we're still paying very close attention to goods inflation for decades after a global financial crisis. We're talking about goods disinflationary pressure, and now we're talking about actually 3 month annualizing above 2%, which is very different from the deflationary environment, goods deflationary environment that we came from. So paying attention to how tariffs are feeding through to the goods component, but perhaps the labor market piece gave some respite to the service side of the inflation.
Wait, how do you diversify? Again, I mean, one of the points that you make is actually diversifiers are scarce. And so in this quite uncertain world, where do you go into?
It's really hard to diversify when historical playbooks are not really playing out exactly as you would have expected them to. So I would observe that in this environment of pent-up inflationary pressure over the longer term because of structural transformation, government bonds are less reliable as a diversifier compared to before. But gold has been a better diversifier because there are other drivers of gold beyond previously kind of dollar and rate differential. We're talking about central bank reserve also representing new demand for this asset class in portfolios. So we think that that has actually played a bigger role compared to treasuries. But diversify your diversifiers is really important.
When you look at France and when you look at Japan, again, these are very political, I guess, reasons, but it goes, especially in France, it goes to fiscal policy. It's something that could be replicated in other countries. How do you play it?
I think the fiscal piece is also a consideration in Japan too, and both developments represent this very difficult trade-off, difficult tension between, on the one hand, fiscal bond pressure, on the other hand, to spend to support economy through transformations. So it represents near-term pressure for asset classes in both countries, and I'm paying particular attention to the fact that when things like this happen, rates are selling off, but currencies are also selling off. That is a somewhat worrisome dynamics I'm paying attention to. But at the end of the day, equity markets may not always be representative of the economy. I say that about the U.S. often, but maybe it also is the case for these two markets as well. So pay attention to equity fundamentals, pay attention to micro, not only macro, as we think about equity allocation.
But when you look at stocks, I mean, they seem to be going from, from record high to record high, with then a little bit maybe of the tech stocks having a little bit of a breather. But how much further can they go?
Well, actually, we're still positive stocks more broadly, but specifically paying attention to U.S. equity market, because when we look at fundamental earnings, U.S. market is the market across the globe that are really driving earnings growth and earnings upside surprise. And within the U.S. is the tech plus rather than the broader market, right? So we follow where earnings are pointing us to, and that is still kind of the U.S. market. For the rest of the market, we want to be more selective. So in Europe, we like likes of financials, we like industrials, and defense names have stood out as well. For Japanese market, we also have an overweight, and that is because of the reform story carrying the earnings growth that is not looking too bad in the global context. But when it comes to equity view, I think pay attention to earnings, because ultimately they could offset the high rate for longer environment.
Wait, is there anything in the UK actually that you like or don't like? Again, there's a bit of turmoil. I mean, this is a fixed-term parliament, so there's nothing, there's no big political changes for the next 4 years, and at the same time, we're seeing the Prime Minister really rechange and reshuffle his cabinet.
Actually, when we talk about the tension between fiscal and the need to spend, the tension between fiscal and also monetary policy, that applies to the UK as well. UK has regularly featured in bond market volatility debate. So we're neutral UK assets at this moment. Yes, they look attractive on a valuation basis, but because of the bouts of volatility that periodically come up, we think that there are better opportunities elsewhere where fundamentals are a bit stronger.
Wei, thank you so much for joining us today. That is, of course, Wei Li, a global chief investment strategist at BlackRock. The perfect way, really, to get us started on a Monday morning, even if it's strike there. So kudos also for arriving on time in the studio. Coming up, OPEC Plus pushes ahead with a boost in oil production. At its latest meeting, we'll have analysis with Jeff Currie, Carlyle's Energy Pathways chief strategy officer. That's next, and this is Bloomberg. Welcome back, everyone. Now, OPEC Plus has announced a modest oil production boost in October. The group says it would restart 137,000 barrels a day of output. Now, the move by the world's top oil-producing nations is set to cast a ball over Asia's biggest gathering of industry executives this week in Singapore, with chatter about an imminent supply glut certain to dominate conversations. Well, joining us here for an oil and broader energy markets is Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle. Jeff, thank you so much for coming on. I know you were meant to be in Singapore. It's their loss and our gain. First of all, what do you make of OPEC's decision actually to increase production at the weekend? Why are they doing it, and will it work, or is there a danger that it backfires?
Well, I think it's a lot like Warren Buffett's staying, where, as the tide goes out, you find out who's swimming naked. In this case, swimming naked is not having spare production capacity. Let's go back, before we talk about this weekend's announcement, let's go back to the unwind of the first 2.5 million barrel per day production cut. So far, they've announced a 2.5 million barrel per day increase in production targets. Let's ask, how much has this translated into oil exports? Right. The answer is 900,000 barrels per day, a fraction of that 2.5. Of that 900, 500 to 600 of it is Saudi Arabia, 200 to 300 is UAE, and then a smidgen of others. If you look at exports outside of core OPEC, they're flat to down. So what is that telling you? There's no spare production capacity in the system. I like to go back to, we're on this show a year ago, and the pundits were all talking about 6 million barrels per day of spare production capacity. It's such a high level of conviction. Well, we now are finding out how much is out there. And I think the key point here, it's limited. So they're going to bring on that 137. By the way, what is 137? Take 1.65 million barrels per day, which is the latter round of production cuts. Divide that by 12, and that's where you get the 137. They're just going to keep bringing it on once every month.
So, Jeff, do you expect OPEC Plus will be going for more increases because it doesn't really matter given there's so little spare capacity?
By the way, it goes, Saudi Arabia is in the driver's seat again. They're the only ones with spare production capacity. You look at the United States, they're not drilling. They've been stagnating around 13.4 million barrels per day of shale production. Russia, flat to declining. And, over the weekend, you had Ukraine take some shots at the Druzhba pipeline. They're not increasing. So I'm going to ask you, where is this, oil coming from? And, this oil supply glut. Again, they were talking about that a year ago. And show me the oil. Where is it? Show me the spare production capacity. Where is it? I'm not going to say we're not going to get an inventory build or we're going to get a contango, but I think what does this mean to pricing? It's a very fine line between oil supply glut and running out of spare production capacity.
But this is, I've never really seen a market with such radical views on it's tighter than believed or we're heading for a glut.
Right. But I think the tighter than you believe story is supported by the data. We're talking about this glut. You have a backwardated market. Inventories in the West are at critically low inventories. People will go, oh, well, it's going into strategic reserves in China. Yes, let me remind you, the United States did this for a decade in the 70s and the 80s. Yes, the Chinese are building strategic reserves at about 1 million barrels per day, but they have 400 billion barrels of spare capacity to keep using, and they got another 200 that they're building underground right now. That's 600 million barrels. This could go on for another 2 more years.
So you're in that camp of it's tighter than believed?
Oh, absolutely.
Full
the market,
stop.
Show me the inventories. But I'm not going to completely discount inventory build as the market absorbs this production increase sometime in the next 12 months. But that doesn't mean prices are going to go down, particularly if you start to challenge the spare production capacity thesis.
So how much of this is actually China adding to its reserves, but also being maybe less visible in the data?
I think it's a combination of the two. The only group that has visibility on global South demand is Saudi Arabia and OPEC. Let's take China. The numbers are estimated at 1 million barrels per day they're building strategic reserves, which is more than the export increases coming out of OPEC. And if we take that as being face value, and that's kind of what the Americans were doing relative to the market in the 70s and the 80s, the current contracts for strategic reserves are expected to end in January of next year. But I like to argue this is part of a broader de-dollarization macro view that the Chinese and other EM players are taking right now. Buy hard assets. Look at gold. We're at record highs this morning. Oil. You might as well stockpile copper, oil, gold as much as you can right now to hedge you against concerns around the dollar. So I don't see this stopping in January. They'll just roll over and keep doing it.
So, to the question, if China can add, keep absorbing excess supplies, there's not much excess supply right now. So it doesn't matter what China does.
We're back to where we were in 2021, 2022 again. But I think the point is that period in 23 and 24, when everybody was so convicted of massive amounts of spare production capacity, it's not nearly as large as people thought.
So, Jeff, everything will go up. Copper, oil.
I'm the perennial commodity bull, and I've been quite wrong for the last, let's say, 24 months. But I still very much believe, that the underlying thesis is very much intact. I like that. There's a stat I love to throw out. My ex-colleagues at Goldman, they do this top projects every year. This year was the very first time there were no new oil projects. Zero. There's no new refining projects. Demand is still growing. We're not at that point where the EVs have displaced all oil demand. So I'm going to ask you, demand keeps going up. Where are we going to get this production? Where is the supply going to come from?
Where?
It's not. Prices are going to have to go higher. You're going to have to challenge the spare production capacity thesis, and we'll get that investment beginning to flow. So, but, again, it's a fine line. Right now, I'm in the minority camp. And you got to see evidence. I think there's ample evidence that this oil supply glut is just not there. Let me ask you another thing is, as a supplier, why would you shoot yourself in the foot? Is bring on this oil supply glut, let the price go down. There is no price war for Saudi Arabia right now. The shale guys have already cut back drilling. Supply is not growing. It's stagnated, or again, as I said, 13.4 million barrels per day. Why are you going to wage a price war with somebody who's already been submissive? So I challenge that thesis. And I like to point out, I've been doing this for 3 decades. I've only seen 2 supply-driven bear markets in my life. One was in 2014-15, and the other one was in 1986. Both were price wars. You can kind of say maybe March of 2020. But outside of price wars, there's no reason to do it.
Jeff, you also wrote, it's a compelling argument. You also wrote this great paper actually highlighting how security was accelerating the energy transition. Where are we now? Oh,
did you see the numbers out in Europe? It's a line going straight up in renewable investment. Let me ask you, why is China investing so much in strategic reserves? They want to wean themselves off of oil imports. They're very dangerous. For all the reason we like oil, portability, storability, are the same reasons it's really dangerous.
But the timeline doesn't really match, right? We need it now, and it will come later.
Right. And so we look at China. They made these investments in cutting-edge EV technologies, nuclear power, lithium batteries. By the way, they can charge a bus in 10 minutes now. They did this long before we knew anything about Paris Agreement. It wasn't done to save the planet. It was done for energy security reasons. And I think same thing. You look at Europe today, they're making large investments in renewables. Why? Because they don't want to be connected to oil imports.
What about the U.S.?
U.S., we actually have gone down, but actually the concerning about the U.S., they're not investing in oil, they're not investing in green, they're not investing in anything right now. Which begs the question, if this energy dominance disappears in terms of this big oil exports and natural gas exports, what happens if they become an energy importer? It's a different ballgame.
How quickly could that happen?
I'm not going to try to.
This is not a prediction. Is it a prediction?
No, it's not. I'm not forecasting that or anything. But I think it's a concern. Is all the talk of keep the prices down, you don't get the drilling. If you don't get the drilling, how do you maintain the energy dominance?
What can you tell us about, defense shares in Europe? How much more? I mean, they've done pretty well in 2025. How much more can they do?
This is a really big thesis. I put it up there with China and, other big, investment thesis. The CapEx boom that defense is likely to generate in Europe is going to be similar. I'm not going to say as big as China was in the 2000s, but it's up there. And I would expect, continue to see a capital rotation out of U.S. assets and into European assets. You look at the euro; it's trading at 1.17, this morning.
But in a meaningful way, because at the moment it's at the margins.
The worst case scenario. You're talking about a $4 trillion capex boom. And let's not forget the side benefits. Why does the U.S. have Silicon Valley? Silicon Valley is a DARPA. All of that is defense contracting. The side benefits of this, miserable, AI. You have ASLM today, making, large-scale investments. So we're moving that direction. I'm not going to say it's happening overnight, but I think this is a big investment boom, and it's going to open up Europe. And I think when we think about the commodity story and old economy and everything, it's an ex-U.S. story, and I think we're moving that direction.
Jeff, thank you so much. As always, Jeff Currie, their Chief Strategy Officer of Energy Pathways at Carlyle. Coming up, we're live in Paris with Georgina Wright to talk, of course, about the confidence vote later this afternoon. This is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The French Prime Minister, Francois Bayrou's government is set to fall today as he faces an uphill battle to win a confidence vote. The Japanese markets face more instability as investors prepare for the departure of PM Shigeru Ishiba. Plus, OPEC Plus defies doomsayers with another oil production boost as the alliance looks to grab more market share. So let's return to one of our top stories, a budget crisis and confidence vote in France. Bloomberg's Caroline Conan is outside the French National Assembly with a guest. Hi, Caroline.
Hi, Francine, and I'm very happy to be joined by Georgina Wright. She's a senior fellow at the German Marshall Fund, and she joins us from the National Assembly here in Paris. Georgina, why did Francois Bayrou do that?
I mean, it's a very good question, basically for two reasons. The first is he wanted the whole of the l'Assemblée nationale, so the lower house of parliament, to acknowledge that debt was a problem and that we needed to cut public spending. And the second is he wanted them to give him and his government the confidence and to say, OK, well, we trust you that you're going to deal with the debt. But of course, all the opponents said this is crazy. You're putting us in front of the fait accompli without letting us actually analyse and discuss the budget proposals. Even former French President Nicolas Sarkozy said it was political suicide. So it was almost inevitable that we came to this point.
Clearly, so tonight we're going to see Francois Bayrou's fall. We're going to get probably a new prime minister over the next few days. Do you think this time President Macron has to be really quick? We have this social anger looming as well. We've got this call to block the country in 2 days' time. You've got another union's call next week. Do you think President Macron has to name a new prime minister really soon? And who can that be?
Well, it's again, I feel like we just lived this back in December. You know,
sure.
if we think of the past sort of couple of years, we've had 5 prime ministers in 2 years in France. I mean, it's unbelievable. The question is how quickly he can do that. President Macron has several options. The first is he tries to name a new prime minister in the hope that this new prime minister can form a government and can get a budget through. But that budget needs to pass before the end of the year. And that's a lot of things that you need to discuss. I mean, Bayrou had proposed 44 billion spending sort of a fiscal budget proposal. The socialists said we want to halve that, we want to tax the super wealthy, we want to actually hand out more help to those who are really, really struggling today. So there are real difficulties and real discussions, and we need that budget to pass before the end of the year. Now, if he names someone, there's no guarantee that that person is going to be able to bring and find consensus in Parliament. So that's one option. The second option is actually to dissolve Parliament, to call new fresh elections. Well, we know by looking at surveys that actually Le Rassemblement National, so the far right, are probably going to do very, very well. Would they get an overwhelming majority to form a government? We don't know. It could be that we have some form of hung parliament again, or fractured parliament. So again, the difficulty of naming someone. And the third is that you use constitutional provisions to try and force a budget through, but that's very unpopular as well.
Which is something we've already lived just 9 months ago right here in France. Who do you think has the best interest in calling new snap elections? It seems like the National Rally really wants Macron to call snap elections. Marine Le Pen, who will actually find out today when the date of her appeal for the trial is taking place next year. So technically, if there are snap elections really soon, she won't be able to run for her seat as an MP. But do you think that's actually what she wants? Because she's obviously eyeing 2027.
Yeah, I mean, the National Rally now is much more than Marine Le Pen. Of course, she champions it. Yesterday, she did her rentrée politique, so, you know, her sort of setting of the stage for the new year in the sort of school year of politics. And she was talking about the National Rally being really a movement, a social movement in France. So she goes much further than that. But of course, they have an interest in fresh elections because they would probably do very, very well. You also have the left-wing coalition, different left-wing parties who have also, some suggested that they would be open to fresh elections because they still believe to this day that actually if you look at the legislative results last time, they are the ones that should be forming a government. So they also have an interest in that. Of course, the big losers would be Macron's coalition because they're likely to do much worse than they did last time.
Even though in the short term, Macron has said he is ruling out new snap elections, he is ruling out resignation. Do you think that if this deadlock continues, given, as you were mentioning, we're still going to have this fragmented parliament, do you think if the deadlock continues, we can't pass a budget, do you think he will be forced to either resign or call snap elections, perhaps in March, for at the same time as the municipal local elections?
Yeah, I mean, that would be a good time perhaps to hold a fresh round of elections, because you already have elections taking place. Of course, they're very different, the municipal and the legislative elections, but it would make sense to try and bundle them up. Also, because the French people are tired of elections, right? They're tired of the deadlock. Some people do want change. Others just think, actually, let's just try and get a budget through and let's just try and get a semblance of stability. But it is very difficult with this parliamentary arithmetic to have any form of stability. And consensus and coalition building is just not France's forte. It's not how the French political system works. So it feels like even if Macron does manage to appoint a prime minister who forms a government, who manages to get the support in parliament, how long will that government last? That's everyone and anyone's guess.
You work for the German Marshall Fund. How is this situation, this current deadlock of French politics, being seen outside of France at the European level? Are they seeing this as a political crisis or perhaps the beginning of a deeper Eurozone crisis?
I mean, many people are very worried that this is the sort of the start of and the beginning of a longer political crisis that could touch the whole of Europe. Partly because France's public spending is very, very high. It's been years that member states, EU countries have said, can you please get your public spending under control? This is a problem. And of course, the successive governments have really failed to pass a budget that has managed to do that in a way that Germany and others expect it to. So yes, there are fears. I think beyond that, though, Europe has never seemed so French in a sense, where we're talking about industrial policy, we're talking about EU doing more on defence. This is Macron's time to shine, and he's so consumed by what's happening domestically. And I think a lot of people wonder where France's leadership is at this time. You put Ukraine aside, of course, the coalition of the willing, France and working with the United Kingdom. There's going to be a summit between Macron and Keir Starmer and the other countries that are looking at forming this coalition, willing to support Ukraine. But yes, there are real problems of French leadership.
Problems with French leadership. How will Macron manage to get the leadership back? That's, of course, one big question. Perhaps at the G7, when France holds the presidency next year. That was Georgina Wright from the German Marshall Fund, live from the National Assembly in Paris, just a few hours before the program collapse of Francois Bayrou's government.
Caroline, thank you so much. Caroline Conan there with the very latest on France. Now, in other news, controversial tax hikes on the rich, oil and gas drilling, and how the world's biggest sovereign wealth fund invests its money could all be shaken up by the outcome of Norway's elections today. Well, the Labour Prime Minister, Jonas Gahr Store, is bidding to retain power in what is likely to be a tight contest. Store currently leads a minority government after his coalition partner, the Centre Party, quit in January. And Keir Starmer has told his new cabinet to step up a gear and deliver for the British people as he seeks to fend off the rise of Nigel Farage's populist Reform UK party. The Prime Minister spent the weekend completing a wide-ranging reshuffle of his government, appointing more than 4 junior ministers after overhauling his cabinet on Friday. Well, Starmer's reshuffle was promoted by the resignation of his deputy just days after he appointed new economic advisors. And wages for new hires in the UK rose at their weakest pace in over 4 years, according to a survey which will be closely watched by the Bank of England. Now, the poll by the Recruitment and Employment Confederation and KPMG found starting pay growth last month cooled to levels last seen in March 2021. Meanwhile, Londoners are facing severe travel disruption as a strike by workers on the city's underground network entered full force this morning. Let's get more with Bloomberg Daybreak editor Mark Perrier. Mark, first of all, I am so grateful to all of the guests and also journalists that actually showed up today, because it's been quite something. Why is this strike happening?
Impasse over work and pay conditions. And the real stickler here are work conditions, with the union requesting that the work week be diminished from 35 to 32 hours, citing stress, work-related stress and fatigue. And the TfL, Transport for London, saying, no way, it's unacceptable. So here we have it, 4 million people who don't have access to the tube in the capital.
I mean, this is a big, network, and it's strikes that basically are coming up one after the other, because it's the signals, it's the people that are driving the tube. What is the impact on London's economy, but also a greater UK economy?
It has a direct impact on the economy, estimated at roughly £230 million. People simply not being able to get to work. But there's definitely a greater impact when you consider consumer spending, retail, hospitality. The numbers are quite difficult to ascertain, but they are huge.
I know. I mean, I know you got here by bike, which, you know, has to be applauded. I'm very, very proud
of you
to taking a bike at 6 a.m., if not earlier. What's the political dimension of this?
The political dimension is that, you know, these are sensitive times for the government. Obviously, worker rights very much in the news, labor strife, and it has, you know, the potential to become a bigger issue because you're dealing with different levels of government and the union. So this whole thing can grow and grow and grow.
Thank you so much. As always, Mark Perrier there with the very latest, of course, on these strikes until Friday, right? Friday midday?
Until Friday. Friday. Service should resume on the tube.
Okay, so there you go, just 4 days of chaos. Now, the Munich Auto Show has kicked off as automakers showcase their newest models while addressing ongoing challenges, including a new wave of U.S. tariffs. Bloomberg's automotive editor, Stefan Nicola, spoke to Volkswagen chief executive Oliver Blume. He began by asking for his view on the trade discussions.
We welcome the joint agreement between US and EU with the opportunity to come to a signed agreement retroactive from the 1st of August on. And that gives us planning security. On the other side, the 15% would be a burden for Volkswagen Group. That's very clear. And we don't appreciate the asymmetric deal in between US and EU because it's distorting the competition in Europe. And therefore, we are counting on our own offer, investing heavily in the US, linked to our growth plan we planned in the US. And there we are in a close contact and good talks with the US government. And we hope that we come to a quick solution also during the next weeks with the support from the US government to our investments, because we think that's very attractive for the US community, building employment, building a supply chain, and that at the end gaining taxes in the US. And that is positive and a better multiplier than having on the other side the tariffs.
Yeah, let's stay in the US for a second. You've long wanted to grow there, and you've made some investments in the Scout brand, for example. Now, things have changed. President Trump is cutting back on EV aid, the tariffs we've already discussed. How do you adapt your North American strategy to those new realities?
Yeah, we are investing heavily, for example, in Scout or in Rivian and other tech partnerships in the US, and we see still a huge growth opportunity for Volkswagen Group with all our brands. And Scout is one positive example to enter now in the biggest US car segment, pickup segment, and the huge rugged SUVs. And Scout stands for this segment, to bringing back a heritage US brand to the market. And what we are offering there is also a car with range extender. You have a internal combustion engine, and offering a huge mileage with these cars, around 800 miles. And I think that's very attractive for the US community. And the car is stunning. We were able to present it also yesterday here in Munich. And everybody is excited, and also the first order intakes are very, very positive for this car.
Well, that was the Volkswagen chief executive, Oliver Blume, speaking at the Munich Auto Show. Coming up, we'll take stock of Donald Trump's presidency, almost 8 months since his return to the White House with Reid, a leading advisor and partner at Actum. That's next, and this is Bloomberg. Welcome back, everyone. Now let's bring you some developing news from Jerusalem now, where our people have been killed. 4 people have been killed in a shooting attack. Now, these are live pictures from the scene. Officials say 12 people have been injured. Israel Army Radio has described the shooting as a terrorist attack. It says the 2 assailants opened fire on a bus and were later neutralized. Now, President Donald Trump's political momentum within his party shows no signs of slowing. The president has a 93% approval rating amongst Republican voters. Now, that's helped give him a stranglehold over Congress. His emergency tariff powers, campaign against the Fed, and deployment of the military within the U.S. are some of the ways in which he's been stretching his executive power. So let's discuss all of this with Morris Reid, partner at Actum. Well, Morris has also been an advisor to prime ministers, presidents, global organizations, and corporate leaders. Morris, thank you so much for joining us. Look, we're almost 9 months into the presidency, the second Trump presidency, and a lot of world leaders, are trying to figure out exactly what his endgame is, because certainly on the foreign policy front, he's in everything.
Yeah. Well, he's in everything, period. Foreign policy, domestic policy, choosing the Tupperware at the White House, all those type of things. But I think that he's really in store for an October surprise. There's going to be two important things happening. Number one, I think there will be a government shutdown. And it will squarely fall on the Republicans. And then the biggie is October 14th. I think the Supreme Court is going to go against him on the tariffs. So that's going to throw everything up against the wall. But Donald Trump continues to be underestimated by the Democrats, by world leaders, and by business leaders. They don't quite understand that this guy is focused, he has a plan, and his staff has been executing really at precision pace and at a very fast pace.
If the Supreme Court goes against him on the tariffs, what happens?
We don't know. This is unprecedented. He tried to use the emergency powers. It'll be a pushback. Obviously, people will want their money back first and foremost. I think business leaders will scramble to figure out what they're planning for, which ultimately means that the economy is going to go in disarray. And on the fact that there was only 22,000 jobs created last quarter, I think that this is going to be a big October surprise for the Republicans.
March, when you say that a lot of people are underestimating him, is it, for example, on the tariffs, is it that he's trying to get money to fund the big beautiful bill and other things, or is it just putting America putting America first, but in changing its place in the world?
Well, first of all, I think they underestimate him because they don't think he has a plan. He came through the door with a plan. He had 4 years to get organized. They're executing on the plan, so people continue to underestimate that he actually has a plan. You may not agree with it, but they do have a plan. The second thing is people continue to think you can flatter your way through this thing with him. That's not the case. Lots of people come and they flatter. He actually wants to get things achieved. Again, may you agree with him or not, they have a plan and they're focused on it, and their ultimate focus is to reposition the global order. He sees things as really Russia, China, U.S., not the rest of the world or the kids at the table. He's really focused on how does he make America, in his words, great again globally as a real superpower.
But see, it's unclear. His relationship, for example, with Vladimir Putin is close 1 week and not so close the other week. So is his end game trying to actually achieve peace, or is it to get closer to that sphere of influence?
I think it's twofold. Number one is to make sure that he's the greatest president that's ever happened. That is ultimately the backstory for him. He wants to be great. That's number one. Number two, to achieving peace, he thinks that he can do what other presidents couldn't do. As of right now, it's unclear if he'll achieve that. Vladimir Putin has, again, his own strategy, his own approach. I don't believe that Trump appreciates or understands what Russia wants to ultimately achieve. He thinks that he can go and use the power of personality to persuade Vladimir Putin. It just doesn't work that way on the global stage.
But what do you mean by being a great president? Is it on the economy? Because the labor market is suffering a lot. Does he measure success? How does he measure success?
Well, that's the real question, because at 2 o'clock in the morning is one thing, at 6 o'clock in the morning is another, at 11 o'clock he's forgotten all about it. Ultimately, he has the opportunity to really change the game. He's blamed Biden. Every time there's something good, it's him. When it's bad, it's Biden. As of the end of the year, first of next year, when this big, beautiful bill starts to really have impact, this is Donald Trump's economy. So he won't be able to blame anyone else. He can't say there's 22,000 jobs just because of Biden. Everything will fall squarely on the Trump administration as things start to roll. And the big, beautiful bill is going to hit at a time, I believe, that's going to ultimately have impacts on the reelection. Next year's reelection, which is why, again, will people misunderstand and underestimate him. The reason that he's going to do the rigging of the election or the gerrymandering is because they understand the impact of the bill will happen squarely at the election time. So what they're doing is being strategic. Where the Democrats are being emotional about this, they're being very strategic because they understand when the impact will happen.
How often do you get asked whether there are going to be free elections in the U.S. going forward? And what do you answer?
Absolutely, there'll be free elections in America. As long as you have $1 billion to spend to run for president, if you can raise money unlimited. People always say about free and fair elections. Elections are expensive in America. This is why you have free speech. People pay for them. So there will always be free and fair, but they will be extremely expensive.
Morris, why can the Democrats not really rally behind a candidate?
Well, I think that they were, first of this is a tough question, right? They did rally around the candidate. They rallied around the wrong candidate, the Biden piece. Secondarily, they then had to move very fast, and that's where they went to Harris. If the Biden people had really moved him out of the way, you would have had a better candidate, a better process. That doesn't mean the outcome would have been any different. As you know, I think a year ago in Doha, I told you I thought that Donald Trump would win. I thought he would win because he was a superior candidate. He had a superior message. What the Democrats have to do is get back to the basics. It's about communicating, connecting, and stop demonizing business and stop talking down to the average American.
But again, September 2025, it's crazy that they haven't been able to find a single voice. There seems to be a lot of infighting within the Democrats.
Well, that's always the case when you're the opposition party, right? When my boss, Ron Brown, took over the Democratic Party, remember, George Bush Sr. was at 98% in the polls, so you have to coalesce around a leader. When you're in the White House, the president's the boss. When you're outside the White House, you have different factions. What's going to happen is there's going to be an election next year. It's going to be people voting if they agree with the direction that Donald Trump is taking them or not. It's going to be less about the Democrats. It's going to be more of a referendum on who's in the White House.
I mean, Gavin Newsom has been doing a social media campaign, which is quite formidable. Actually, does that work?
It works in the short term.
Yeah.
In the short term, it does, because what he's doing is he's playing to the base. The base is looking for a hero, someone muscular to push back. Beating Donald Trump doesn't mean you have to be exactly like Donald Trump. You have to show some authenticity. What Gavin Newsom is doing as an incumbent term-limited governor, he's fighting back.
Yeah.
He's the opposition. There's a void. He's filling the void. Does that mean that this will work for him to run for president? I'm not for sure. But right now, the Democratic Party, they're looking for leadership. They're looking for someone to push back, and Gavin is playing that role.
I mean, a lot of CEOs will, maybe not on the record, but actually, in corridors say they worry about the fact that there's no real opposition, that people are afraid of speaking up because they don't want to be in the fire line of President Trump. I mean, this is concerning.
Well, it's concerning from a business standpoint. A lot of business people don't want to be in the fire line. That's why they capitulated, gone to Mar-a-Lago, cut deals, kept quiet, flattered, doing all those things. That's not the role of business. That's the role of politicians, right? So the Democratic Party, the opposition has to get organized. They have not been organized. They've been distracted and emotional. They need to get organized. They need to come up with a message. They don't need a leader right now. They need messengers to push back on the White House.
But it's also unclear to me what some of the Trump administration is trying to do with business. That 10% of Intel, some of the deals that have been cut with some of the tech companies to get some of the revenue. Is this a dangerous precedent?
Well, it's unprecedented. The democracy of the American statute has never done that. We don't have a sovereign wealth fund. We have a big, beautiful country and businesses. But again, the presidency takes on the personality of who's in the White House. Right? Any president could have done and could do what Donald Trump is doing. They've chose not to. They've looked at being president as something that they aspire to be. They really say, like, I'm happy to be here. It's bigger than me. Donald Trump is redefining the presidency. He's ultimately making it a personality-driven presidency. Now, this trend has been happening all over the world. It's just now arrived in America, and people are seeing it at an unprecedented level. But Donald Trump is doing what every American president could have done, but chose not to do because they felt the presidency was bigger than them.
And so how's that playing out with actually approval ratings on a national level, and how will that change?
It's polarized, right? You have 92% of Republicans say he's doing great. 2% of Democrats are for him. So it's a polarized situation. What's really happened is Donald Trump, the Republican Party, is organized and energized, right? That's what you see at 92%. Organization and energy, right? When you're at 2% with the Democrats, you see they're distracted and emotional. The Democrats need to get their act together. Donald Trump, whether you agree with him or not, had a plan, and he's executing on that plan.
Morris, do people like his personality, or do they like his policies?
Well, it's two things, right? Some people like his personality. He's an affable, funny guy, right? He says crazy things, right? So people do like his personality. The thing that's really interesting about Donald Trump is it's style versus substance. A lot of people get caught in the style, but there's some substance behind it, right? The China situation. People have agreed with that. Situation with NATO. People agree with that. It's his style that people get distracted with, but the substance is sometimes there.
Morris, thank you so much, as always, for joining us. Morris Reid, their partner at Actum. Up next, Bloomberg Brief, and this is Bloomberg.